Here's a question worth asking today, Monday the 27th of July 2026. If the US dollar keeps getting squeezed by rate cut chatter, why isn't the British pound running away with the gains? According to analysts at BNY, the answer comes down to one word: fiscal risk. Despite plenty of reasons for sterling to push higher against the dollar, BNY says the UK's own fiscal position is acting like a ceiling, quietly capping how far the pound can climb. This isn't a small technical footnote either. It's a theme that's now been echoed by more than one major bank in the space of just a few days, which tells you the market is genuinely worried about it. Stick with this video and we'll unpack exactly what fiscal risk means in this context, why it matters right now, and where the pound-to-dollar rate could be headed next. As things stand today, the pound is trading in a holding pattern against the US dollar. It isn't collapsing, but it isn't breaking out either, and that stagnation is the story. BNY's latest note points directly at UK fiscal uncertainty as the reason traders are reluctant to push pound sterling to US dollar meaningfully higher, even when broader dollar sentiment looks soft. Meanwhile, against other currencies the picture looks quite different. The pound has actually been consolidating near recent highs against the Japanese yen, which on the surface sounds bullish, but even their analysts have flagged intervention risk from Japanese authorities as a factor limiting further upside. So the common thread across multiple pairs is the same: sterling has strength, but something is consistently capping it. Against the yen it's intervention risk. Against the dollar, BNY says it's fiscal risk. Both point to a market that's cautious rather than confident about sterling's next move. This isn't a lone voice. Just last week, on the 21st of July, BBH published its own analysis making almost the identical point, that fiscal uncertainty is capping the pound's upside against the dollar. When two separate research desks land on the same conclusion within days of each other, it's a signal the market consensus is genuinely shifting toward caution on UK fiscal policy. Earlier in the month, on the 13th of July, BNY also published a note on gilt market confidence and new leadership, suggesting that questions around who is steering UK fiscal and monetary policy, and how credible their plans are, have been building for several weeks now. Put together, these three notes tell a consistent story. It's not one isolated data point spooking traders, it's an accumulating pattern of concern about Britain's borrowing position and fiscal credibility that's been developing through the second half of July. Let's make this concrete. When analysts talk about fiscal risk capping the pound, they mean concerns about how the UK government plans to fund its spending and manage its debt load. If investors doubt the sustainability of that path, they demand higher yields to hold UK government bonds, known as gilts, as compensation for the extra risk. Higher gilt yields sound like they should support the currency, since higher yields often attract foreign capital. But when those higher yields are driven by worry rather than by a strong economy, the opposite tends to happen. Investors start pricing in the risk that borrowing costs could spiral, that fiscal plans could be revised, or that political pressure could force a change in course. That uncertainty makes global investors hesitant to commit fresh capital to sterling assets, and that hesitation is precisely what shows up as a capped exchange rate, even when the dollar side of the equation looks weak. This matters well beyond trading desks. For UK businesses that import goods priced in dollars, a capped pound means import costs stay higher for longer than they otherwise would if sterling were free to appreciate. For British holidaymakers converting pounds into dollars for a summer trip, it means the exchange rate you get today reflects this fiscal caution baked into the market. For pension funds and institutional investors holding UK gilts, the current environment means continued volatility in bond prices as fiscal headlines move markets week to week. And for the Bank of England, a capped currency complicates the inflation picture, because a weaker pound than fundamentals might otherwise justify can keep imported inflation pressures elevated for longer, an unwelcome complication for policymakers already managing a delicate balancing act. It's worth zooming out, because the pound story is playing out alongside major moves elsewhere. Commerzbank noted on the 23rd of July that markets are increasingly pricing in an ECB rate hike in September, which would mark a notable shift in European monetary policy and could pull capital flows across the Eurozone, sterling, and dollar in new directions. At the same time, persistent dollar strength has been a talking point across asset classes, not just currencies. TD Securities warned in late July that dollar strength, combined with Federal Reserve policy risk, is capping the upside for gold as well. That's a useful cross-check. If the dollar is strong enough to cap gold, a traditional safe haven, then it's not surprising it's also proving resilient enough to keep the pound in check, fiscal risk or not. The dollar side of this equation is doing real work too. Looking ahead from today, the near-term path for the pound against the dollar likely hinges on two things converging. First, any fresh UK fiscal announcements, whether that's from the Treasury, the Office for Budget Responsibility, or broader Gilt auction results, will be watched closely for signs that fiscal credibility is improving or deteriorating further. Second, incoming U.S. economic data and Federal Reserve commentary will continue to set the tone for dollar strength generally. If UK fiscal concerns ease, even without any change in US policy, BNY's analysis suggests the pound has room to move higher, since the cap would be lifted rather than the underlying strength disappearing. Conversely, if fiscal worries deepen, expect the pound to stay range-bound or drift lower against the dollar regardless of what happens in Washington. Analysts will be watching UK gilt yields as the clearest early signal of which way sentiment is tilting. So here's the headline to remember: the British pound isn't weak against the US dollar because of anything the dollar is doing wrong, it's being held back by concerns closer to home. BNY's warning about fiscal risk, echoed by BBH just days later, tells us that UK fiscal credibility has become the single biggest swing factor for sterling right now, arguably more important than the usual interest rate differentials traders normally focus on. For anyone tracking currency markets, UK gilts, or planning currency conversions in the weeks ahead, the message is clear: watch the fiscal headlines out of Westminster as closely as you watch the economic data out of Washington, because right now, it's UK fiscal policy that's setting the ceiling on the pound. Thanks for watching, and if you want to stay ahead of these currency market shifts, make sure you're subscribed for our next update.